Hi everyone, this is Jason Burek of Wall Street for Main Street, and today is Thursday, July 1st, 2010. Today in the markets, gold, silver, and oil all got chopped pretty hard, slashed pretty hard. There's a big jobs report coming out tomorrow, so it will be interesting to see what the results are for that. I mean, it's obvious that the jobs reports are not going to be fully honest. You're going to have to be able to dissect them. So look for commentary from Peter Schiff and other people on their actual opinions of the job reports as people dissect them, because the initial numbers are not necessarily going to be completely accurate, because if there were more jobs created, a lot of them could just be short-term jobs. But what I wanted to talk to you today about mostly was the fact that talk a little bit about my investing philosophy for the long term here, and talk about how it's aligned with China's investing philosophy. I wrote an article about 2 months ago on China's $2 trillion dilemma and how to potentially profit from it. So if you have not read that, or if you don't remember what it was about, I strongly suggest you go and check it out. It explains what China is going to do for the long term. In the past, more than 10 years ago, China started buying oil on long-term contracts, 20 and 30-year long-term deals for oil, with out in the market there, and also directly with Russia and Russian oil companies, and now in Brazil. They are securing long-term oil contracts at around market price or slightly below in exchange for their cash. China is the largest bank in the world, and they have subsidiaries. They have China Sovereign Wealth Fund, China National Investment Corporation, stuff like that. Those are basically their investing arms of the government. Those guys have fund managers, and those guys are in charge of the funds. They think long term. They are value investors. They understand the peak oil stuff and the other peak metals, and how the production costs for these are going through the roof. The whole thing about peak metal and peak oil that most people, and also peak coal, in general, just a lot of peak commodities, and also water, that most people don't understand is they don't understand that we're not actually running out of these commodities really quickly per se. It's that it costs a lot more money in terms of exploration costs, production costs, etc. to bring these projects online. A large mine, a large gold and silver mine or copper mine, now costs like $2 to $5 billion. If you go and look at Barrick and Newmont and Goldcorp and these guys are spending up front a couple $1 billion at some point, and so is potash for a potash mine, and that's a lot of upfront capital before you make any of it back. So the input costs are just ridiculous, and China is smartly securing long-term supplies to fuel its growth. One of the best ways for me, and this is part of my personal investment philosophy as a long-term investor, and I'm committed to this for long-term, so more than a year. When I enter a position, I am committed to gold and silver for a lot longer than a year. I'm not going to bail out at the first signs of trouble like today. In fact, I try to take as much emotion out of it, so when something like this drops, I hope I have more cash through an options trade or whatever. I hope I have a couple hundred or a couple thousand or whatever dollars lying around, so I can dollar cost average, continue to average into my position. These key commodities here are in long-term secular bull markets. What that means is that these commodity prices have been going up for a decade already, and they will go up for another few decades. There are long-term, very powerful trends at play here. One of these is overpopulation in the world, globalization, and other stuff. People want the westernized stuff. People want a more westernized culture. They want to eat more proteins in their diet. They want healthier foods over in India and China. They want electricity. They want computers. They want cars. These people are paying cash too. So as a gold investor here, when I have more cash, and I do have a little bit more cash from an options trade, but I'm not quite ready to deploy it yet, I will be taking that extra cash and I will be averaging into either gold and silver stocks or other commodity stocks I already own, or continually buying more. I'm trying to take the emotion out of it. I'm a long-term investor. I do not want to lose my position, as Eric King and others have said, of King World News have said, about a long-term bull market. I want to make sure that I have positions for this long-term bull market, because the real move, and we're really only in phase 1 or phase 2 for some of these bull market moves. We're not anywhere near the mania stage. The real move is coming like in a few years, when people really understand exactly what's happening. So the people who say the trend's not defined, I beg to differ. I think the East, the people of the East, the peoples of the India and the tiger nations outside Japan and China, those people are defining the long-term trends now. Those people have capital. China has capital. They have a lot of capital to deploy. So in the last week, something, current events that some of you might be aware of and some of you might not, China is so desperate because it is holding so many dollars, euros, and other treasury stuff in its reserves. It's holding so much paper, over 2 trillion total, in fact, that China is now willing to go directly to a gold mining company, silver and gold mining company. In fact, they went to Coeur d'Alene, symbol CDE. And Coeur d'Alene is bringing online this pretty large gold mine up in Alaska called Kensington. And China, instead of a gold mining company getting paid 2 to 3 months later after the gold concentrate is delivered to the smelter, China's one of China's sovereign wealth fund wings that I was talking about, they have cash in hand and they're willing to pay Core a week after. So this is a win-win situation. China does not want to overpay necessarily on the open market for gold to drive up the price. This is what I'm talking about, continually adding. So you should definitely take a look at Coeur d'Alene, symbol CDE. It's going to be very strong in cash flow because China is going to be paying it upfront pretty much for the gold. That to me signals desperation, that China thinks the gold price might not drop that much further and they don't want to risk it. But also, if the gold price drops further and other key commodities drop further, I expect China and other countries that are growing, that expect large growth profiles, over 8% per year on average, I expect them to go in and continually buy oil and other stuff. I look at production costs of mining companies across the board. I'm looking at marginal producers and low-cost producers to give me an average of where the bottom for a lot of these commodities would be in a trading range. So if oil were to drop down to $50 a barrel, if it went much lower, it would be way below its production cost, and a lot of these big oil companies would go out of business. So that's some stuff you need to learn to look at and analyze. And you do this by looking at different companies and not necessarily looking at the commodity stuff themselves. You got to go in there and look at the costs for each company, like their cash costs and stuff like that of the producers. So I'm just giving you a little stuff. I'm going to be probably averaging into some more gold stocks and or silver stocks as we go in the next coming months. And I honestly, if the price drops, fine, I'll buy more. I'm willing to hold. I'm only 27 years old, baby. So everyone have a great weekend. Happy July 4th. And I will probably be back tomorrow maybe to talk about the jobs report and give you a commodities market wrap up for the week. Okay, bye everyone.